Recently, a few of my friends and coworkers start asking me what's the best way to invest in the stock market for a new beginner. They wanted to limit their short-term risk to the downside while still collecting a decent return in the long term. The plan is very simple. Let's dive in to find out. To invest in the broad stock market and don't get affected if a company or two that you picked will go down, I would always recommend start investing in an ETF. But choosing the right ETF is critical to get the result that you want for the long term. The first ETF that I recommend will be the S&P 500 VOO. So if we go here and we choose the Vanguard S&P ETF, this ETF has the lowest expense ratio by far in the market. If we scroll down here, you will see that the expense ratio is 0.03, meaning you will pay $3 for every $10,000 invested in this ETF. And you won't even pay it like it get cut from your account. It just gets reduced from the ETF itself over the entire year. So you won't actually being able to see the $3 fee. An important factor to consider when choosing an ETF is how much asset under management for that ETF. For this particular one, it's the biggest on the market. Their asset under management is 1.18 trillion. Well, that's with a T. It's not a B, and it's definitely not a million. So as you can see, it is really safe to be invested here. The Vanguard S&P 500 ETF VOO, it consists of the largest 500 US company in the stock market. Right now, if you see the number of holding is 507 to be exact. So sometimes they add company, they remove company based on their performance, and they do that on a regular basis. If you scroll down here, you will see what's in this fund or ETF. The technology make up the biggest part is 31.52, while finance will be 12.45, healthcare, consumer, communication services, industry, and so on. You can see the percentages of each of them. That's what make up the S&P 500 ETF VOO. The top 10 holding in the ETF make up 34.07 of the total assets, since they are the largest companies in the US stock market. So let's take a look at them one by one. The first one is the biggest in the stock market right now. It's Microsoft, and it make up 6.96. The second is Apple. The third is Nvidia. The fourth is Amazon, followed by Meta. Alphabet has two parts since they are divided into two type of shares: Berkshire Hathaway, Eli Lilly, and lastly JP Mortgage. Let's take a look at the historical return for VOO. If you go back like 1 week, you see it's not much has changed. You went up and down. You look at 1 month, it has been up 1.77. 3 months, it's been up about 10%. Year to date for this year, it has been amazing, and it has went up 18%. That's definitely above the average, and it has started the year in an amazing way. Let's look at the 1 year performance is 24%, absolutely amazing. Let's take a quick look on the performance of the S&P 500 over the last few months and few years. If you look here over the last 1 month, it went up 1.7. Over the last 3 months, went up 10%. Year to date is absolutely amazing. It's up 18%. Over 1 year, it has been up 24%, much higher than the average return. The 5 years here, you can see that although it dipped 2 times, the first was for a short period of time. That was during the disease, and it recovered fairly quickly with everything that happened, only because the Fed saved the market by pumping so much liquidity into it. And it continued rallying big time in 2021. At the end of the year, that was like the second peak before it started dropping down because of inflation. As you can see, the inflation hit the whole stock market and the S&P dropped significantly. It was a big drop. If you have bought in the peak, you wouldn't have felt very good at that bottom. However, if you hold your stock or average up, you will see that the stock market recovered last year and this year, and right now it has generated an 85% return over the last 5 years. Absolutely amazing. Even with these two big dips that happened, the US stock market always prevail. Let's look at the maximum. The maximum here start from 2010, since that was the inception of the VOO from Vanguard. Until that point, there used to be a lot of other ETF that charge much higher fees per year, anywhere between 1% to 2 or even 3%. Vanguard came and started creating this new ETF with much lower fee and forced everybody to lower their fees after that just to match them because everybody start investing in Vanguard and in their ETFs. So from September 9, 2010, you can see the return to today, even with the drop, is about 399%.66, or we can just say 400%. Absolutely amazing. That's on top of the dividends that you are collecting each quarter. Let's jump quickly to a NASDAQ website to check the performance for VOO. As you can see, the dividends yield for the last year was 1.37% per year. That's absolutely great. That's on top of the gain that you get. As you saw here, that the gain for the last year was 24%. Like, this is not enough. You get paid dividends on top of it. You can see the dividends here varies from one quarter to another, and that basically because the dividends that VOO paid is based on the dividends of the companies inside the ETF that paid during that period. But overall, they are going to the upside, of course. Like if you scroll down, for example, here, and you see the first payment in 2010, you see it paid 27 cents per share. While here right now in 2024 is paying $1.78 per share. Absolutely great because it's much bigger and it's going to keep increasing with time. The second name on the list is QQQ. The QQQ has 100 of the largest companies in the NASDAQ index. Since the tech companies always grow at a larger scale, its performance is much higher compared to the VOO. So if we look here at the 1 week, 1 month, 3 month, year to date, and then the 1 year performance, 5 years, you can see it's always higher than the S&P 500. The 5 years performance, for example, is 148%. Compare that to the performance of VOO over the last 5 years, which was 85%. It's so much better, so much higher. However, when it goes to the downside, it will also go lower than the VOO. If we press on the max return, and this will show you the return from January 2000 all the way to 2024. And as you can see, it's a return of 461%. Even that includes so many big dips over this long time. If we scroll down here to see, you can see the number of holding is right now is 102. The sector inside of it is 52 technology. And then as you can see, the other sectors are much smaller in size. If we scroll down, you will see the top holding, which make up more than 50% of the total asset inside. Of course, the names that dominate is the big, mega large companies. That's Apple, Microsoft, Nvidia, Broadcom, Amazon, Meta, Tesla, Alphabet in both their classes, and finally Costco. If we scroll down more, you will see the key statistic. One of the most important one that we said we look at it is the asset under management here is $301 billion, and the expense ratio is 0.20. A little bit more than VOO, but totally worth it since the growth return here is so much better. The third and final name we have on the list is SCHD. That's from Charles Schwab US Dividends Equity ETF. Let's quickly look at the performance over the last few months. You can see the 1 month is 6%, the 3 month is positive 8%, the year to date is 8.5%. The 1 year is plus 12.5, and the 5 years has been 52%, while the maximum, which is start from 2011 when this ETF was created, is 229. Let's go back and focus on the 5 years. The 5 years performance are lower than both the VOO, which was 85, and the QQQ, which was 148. So why do we add it to the list? Well, this ETF gives you a stability. This include a quality and a value companies that pay high dividends. So if we go here to the Vanguard and we search for SCHD, you will see that the annualized dividends are 4% per year, which is absolutely great. Again, similar to VOO, the percentages are different in each month because it's, again, the companies inside of it who's paying the dividends. So it's also going up over time. If we scroll down here all the way to 2011, you can see that the first payment was 12 cents per share, while right now in 2024, it's 82 cents per share. Let me also show you the QQQ. Although it's a growth stock, it still have a tiny amount of dividends since some of the companies inside pay dividends. So, and it's not bad at all. It's 0.61% per year. Like on top of the 148 you got over the last 5 years, you are still getting paid these amount of dividends every 3 months. And I'm just going to scroll down to show you all the way to the beginning here. The history start at 2012. If you are a complete beginner, I will advise you to start reading about these three names and check their history, how they perform over the good time and the bad time. Check how much they will drop in a normal recession. How did they perform? Does Binance work out for what you are looking for or not? There is no guarantee that you will get the average for the historical return, but if that was the case, is that return acceptable to you? Is it too high, too low? Depends on what you want. So when you start investing in these three names, it gives you a broad contribution to the market and big protection to the downside. So a single stock going down will not hurt you since there is a 500 name in the S&P 500 and 100 name in the QQQ, while Charles Schwab has 103. And let me scroll down quickly and show you what's in the ETF. As you can see here, the finance is actually leading in this ETF since they pay good dividends, followed by healthcare, consumer defense, industry, energy, consumer cycle, and so on. You can see that the technology here is only 8.76. The top 10 holding make up 40% of the ETF. The first one actually is Home Depot with 4%, and followed by these names. You can pause the video and read the list if you want. If you scroll down, the asset under management is 57 billion, and finally the expense ratio is also very, very acceptable, is 0.06%. The price to earning ratio is by far the lowest compared to the QQQ or the VOO. It's 15.57, meaning you are paying a little bit lower compared to buying the VOO or the QQQ. That's act as a defense in a downturn since it won't drop as much as the other two ETFs. Well, my recommendation for new investor is to do their own homework or research, and after they are convinced and came down to the conclusion that they want these three names or any other three names, they must divide their investment between them. Something easy to start with is I would recommend putting a 25% in each name. That's a total of 75% of your investment in these three names. I'll leave the other 25% as cash. That's maybe for individual stocks when you start reading more about the stock market and you start knowing what stocks that meet your criteria of investing, whether it pay dividends directly to you or it has a big potential for growth. You can slowly start picking these names and investing in them. Now, since we are close to an all-time high for all three of these dividends, like if you look at Charles Schwab, look at that. You look at the marks, it is absolutely at the peak. If we go back to the QQQ, it's very similar. Like today was a red day, but if you look at the bigger picture, oh my God, it's at an all-time high as well. And finally, is the same for VOO. Again, it was a red day for it. However, if you look at the marks, it's absolutely at an all-time high. So in this case, it's really risky to go ahead and just invest all your lump sum of money. So the 25% that we divided in each name, I would recommend you divide that over 10 or even 20 smaller investment, and you start investing a small part each week or month, whatever you find reasonable for you. A month will be more reasonable if you divide it into 10 pieces, or if it's 20 pieces, you might want to do like every 2 weeks, 3 weeks. That's called dollar cost averaging, meaning you are going to get the days that it has a bigger discount and you are going to get the days that it has a bigger gain, resulting in a smaller amount of shares for your account. Overall, if you watch some videos, it will advise you to invest all the lump sum of money comparing to the dollar cost averaging, because historically investing all your money in the stock market is better than timing the market or waiting for a dip. However, that does not take into consideration that currently we are at an all-time high and we are more than due for a correction anywhere between 5 to 10% or even more in the short term or medium term. So since we don't know when that will come and it's hard to time the market, it's better to start investing slowly, and then if the market dip big time, then we can increase the investment amount during that dip and buy everything on discount. Finally, I want to show you the S&P mob. That's at the end of today, which is July 17. All the winner of the year that has a big gain like Nvidia, Microsoft, Apple, Google, Meta, Tesla, Amazon, Eli Lilly, and so on have dipped big time today. But for you as a new investor, that could be a great opportunity to start buying into these stocks and tap into their power over the long term. You can change here to see the 1 week performance. You can see that Nvidia has been right for this week, and so is other name. You can change it to 1 month and check the performance here, and you can do all the way to 1 year. Of course, if you go 1 year, almost all of them, with the exception of few names, are green, super green, since it has been amazing recently. The stock market have been recovering big time. So that's the end of the video. I hope you like it. Please let me know in the comment if you have any question or suggestion. As always, the information provided in this video is for education purpose only and should not be constructed as a financial advice. Investing involves risk, including the potential loss of principal. If you find this video useful, please consider give it a thumbs up, subscribe to the channel, and see you in the next video. Thank you.